Okay, let's get in one more voice. Shankar Sharma, First Global, joins us right now to speak about the index at large and what's really happening with the markets. And Shankar, I read a recent report, or rather an interview that you had given in one of the dailies as well, speaking about your stance. We'll come to the markets in a bit, Shankar, but just one quick word really on the disappointment by Infosys, which has actually dragged the CNX IT as well as the indices down a bit.
Yeah, last quarter they flattered to deceive clearly, and unfortunately I haven't had time to really go through the result because I'm traveling today. But clearly the tape is telling you again the story that the stock, I think, almost back to the level where it had that big up move in the previous quarterly numbers. So overall, looks just the headlines of the results are quite terrible, to say the least.
Shankar, you've talked about the Sensex sinking to 16,000 levels. Is it going to be sooner than later that we'll see 16K on the Sensex?
How do you know that? How do you know I've said 16,000?
Just quoting from some newspaper interviews, Shankar.
Because the interview I recorded with you has not been aired yet, right? So you're letting out sensitive information beforehand.
Okay, what is your take on the market then, Shankar?
All right, okay. No. Anyway, it's pretty public, whatever I have said, so no problems. The take is pretty straightforward here. I mean, again, the screen is telling you which way it's headed. We will have intermittent rallies here and there, but it doesn't look at all pretty from at least my seat. And no matter where we try to hide, I think we'll still end up dropping money. One would have thought that IT would be a relative safe haven, but after Infy's results, clearly that doesn't appear to be so. ITC itself has been looking very, very shaky of late, so one doesn't know what is underlying that. So, in a real vicious bear market, there are very, very few places to hide, unfortunately.
Shankar, so, okay, a simple question really. If indeed the view is bearish for the next 6 to 12 months, as the case may be, I do not know that, what is it that could stand out, if at all, or do you believe the falling tide will actually take almost all the boats along with it?
Well, in 2008, there was only one boat that was above the tide, and that was Hero Honda. That was the only stock that closed up for the year. So you can imagine what, all defenses also fell. Everything fell. Some fell 25, some fell 50, some fell 80%, but everything fell. There's just one stock in the large cap names that actually went up for the year. So, that's the way vicious bear markets are. And looking at the globe, looking at the US, looking at Europe, I'm pretty sure that you will start to see even the developed markets sell off in the next few weeks' time, and quite sharply. So our markets have already been weak. Now all you need is sort of the larger markets to start to correct, and then imagine what happens here. So yeah, things are not looking good.
Right. Shankar, the other bit would be what drives this pessimism? I mean, is it what fears you most? Is it what scares you most rather? Is it really the political situation in India, or for that matter, geopolitical situation globally? Is it valuations which seem to be okay right now? And they're not too expensive per se compared to historical averages. So what is it that scares you the most about India?
Politics is okay. Politics, there's no problem. The UPA will come back with a thumping majority. And that's it. So if that's what is bothering the market, then I want to just tell the market that, all this hoopla around one particular chief minister, is all highly misplaced. So I don't think politically there is any big issue. And, the JDU also probably going to join the UPA sooner rather than later. Things are looking good on the political front. Coming to the valuation, I never look at valuation. So I really don't know what the market is trading at just now. The only thing I look at is that the global macro and Indian macro both look very, very bad. Indian macro has been bad, emerging market macro has been bad, and global macro is bad. We have, the Fed has kind of papered it over, but still one can't hold out hope that this whole endless game of printing money can last a long time. In fact, there have already been noises by a lot of quarters in the US, the St. Louis Fed, etc., who was saying that the Fed has to come back to a more normal monetary policy. A more normal monetary policy would be havoc for the markets. So that entire stimulus will have to be phased out over the next few months' time, maybe a couple of years' time. But the markets will start to discount that before. So, the macro is what I really focus on almost all the time, and that doesn't look pretty at all anywhere you wish to look.
So, Shankar, are there any hiding pockets at all? How would you tactically approach the market, or just accumulate cash, and when the opportunity is ripe, start deploying money?
That's provided you have cash left at the end of this. So, assuming you have a bit of cash, I would stuff it under my mattress because, I can't put it into European banks and I can't put it into too many Indian banks now that I know, what's going on. So, the best place really speaking is, and I've said this, in the last many years, that for a small investor, the stock market is no place. That's really meant for professionals belonging to the 2 square mile of Fort and Nariman Point. Beyond that, it's very hard to make money in the market. So they should be sticking to bank deposits and fixed income wherever they can find a reasonable yield. It is not about return on capital. It is really return off capital, which you will get back, obviously, when you put money in a bank FD. So my view is clear. Put it into a bank FD. Put it into gold also if you're a local investor, because even though gold looks bad from the dollar perspective, I think the rupee price of gold will still be okay, because given whatever we see, it seems reasonable to presume a reasonable decline in the rupee, which means the rupee price of gold might well be a reasonably safe haven to put your money into.
Shankar, just one more point really, since you brought the topic about specific banks as well. If I'm not wrong, you bearish on the PSU banks. You're doubtful about the kind of quality or any quality at all left in the PSUs at least.
No, we are bearish on all banks, private sector as well as PSU, and more so private sector, because that is where the big pocket of negative surprises can come from, be it by way of earnings misses, guidance, or whatever it is. PSU banks are already a poor lot. They have been beaten out of debt in general at almost all bear market cycles. So, the bearishness is more actually on the private sector banks. And we just put out a piece of research, 3 or 4 days back, in which we have talked precisely that the 4 major banks, which is SBI, HDFC Bank, ICICI and Axis, will contribute something like 50-60% of the Nifty's earnings growth this year, and about 30-40% of the Nifty's earnings growth next year. That is this year meaning FY14, and last year was FY13, where they contributed half, and current year they'll contribute 30-40%. When an overwhelming part of your growth is coming from 4 stocks, and those 4 stocks are headed towards a very, very rough patch by way of their either the liability growth or the asset growth or both, it doesn't take a rocket scientist to figure out that, those banks are going to be busy collecting their money, recovering money rather than giving out fresh loans in this year. So I don't see banking earnings coming through the way at least the market is penciling in 15, 20, 25, 30% growth, depending on which bank you're talking about. I see room for disappointment there. And when that happens, your Sensex earnings will not be, or Nifty earnings won't be, the 15-odd% that we are all projecting. It will be more like 5 or 7%, if at all that much. So if you're looking at 0 to 5%, Sensex growth, Nifty earnings growth, then take your bet what Sensex or Nifty levels you want to take.
So Shankar, how does traders approach this market? Should one go short on the market or the bank Nifty in particular? Would that make money for them?
Well, if you are a trader, you can. There are plenty of things to short out there. The entire Nifty, the Nifty itself has been a short from middle of January. And depending on how nifty you are, really speaking, in your trading strategy, you can be in and out very quickly. But I don't see too many long trades out there if you're really talking about where one can hide and make some money or save some money. I don't see that many out there.
Shankar, a small lipstick. Since you mentioned Hero Honda again, just want to come back on that. And everybody's been writing obituaries about how auto companies might do. They're trading cheap, but they've probably traded cheaper in the past as well. Maybe an odd Tata Motors by virtue of JLR is doing okay. But do you think autos are in for a rough ride even ahead for the next 6 to 9 months? Just looking at how the macro situation or the economic situation is panning out as well.
Yeah, definitely. Again, we have been table thumping bulls for now for like 5 or 6 years, right? From 2007, 2000, even when the bear market started from 2008, that's the only sector we have liked. And that's been the best performing sector in the market by far. But again, it's time to bid goodbye to every sector, and at least I'm not a big believer in buy and hold and 5-year views and all those kind of things. So, this sector will face headwinds. That consumption as a theme is now beginning to show a little bit of stress. So whether you take auto sales or two-wheeler sales, etc., and I was talking to people in the FMCG business, they're all saying that there is some degree of headwind we are facing on the consumption side. So these are all pure consumption plays, and they will also we definitely hit along with, the more traditional plays like banks and infrastructure, and metals, etc.
What's the most attractive short though, Shankar, when it comes to the Nifty 50 basket?
Why are you asking me short ideas? Ask me long ideas, because that conversation will be over in 10 seconds.
Shankar, you just said there are hardly any long ideas.
Short ideas we can keep talking about till Christmas.
Okay, let's do that. Let's start now.
No, well, I mean, look, the Nifty itself, depending on, again, you have to pick the right levels, will be a short. Bank Nifty is a short. The entire infrastructure space, the large cap infrastructure space, metals, all of them. I mean, there's it's really, you're at a buffet. If you're a short seller, or even a hedge fund who wants to hedge his longs, there's plenty out there.
What about the longs?
Well, I have to only keep silent because there are not that many that I would like to go home every evening with. There's almost nothing.
Okay. So, Shankar, the reason why we are I'm just repeating this question, is because there are tons of people who would be watching you right now, hearing you right now, and they've been advised by more Tom, Dick, Harry about certain pockets to stay on as well. You're saying that for now, it's just great to put the money under the mattress. If you have a portfolio, even if it consists large caps, probably just take money off the table and keep it, at least selectively take money off the table and keep it for maybe lower levels.
Look, I mean, people keep talking about value, but there is no meaning in buying value unless you see positive momentum. And all the momentum right now is on the downside. And I don't think it will be changing anytime soon. Like I said before, that there will be intermittent rallies which will kind of convince you that the worst is over and, good times are back, etc., etc. But those are always sucker rallies. So the prudent strategy is to, really speaking, just remain in cash, buy some fixed income, and not get too exposed to this market, because this is going to be pretty vicious. At least that's our read on the situation. We could be wrong. People who advocate buying on the dips could be right, but those are all differing opinions in the market, and I respect that. That's fine. That's somebody's point of view, but our point of view is what it is.
So, to your mind, Shankar, what could change it, if at all? Would the change essentially come from the global front, or could things in the domestic front change for your view to change?
All the changes will have to occur from the global front, by and large. On the domestic front, I think we are still ticking down in terms of global data. In terms of local data. So, I don't think GDP growth will be very sunny this year. I think people are talking about turnaround a bit too soon, because more I disaggregate the GDP growth numbers, I don't see where you will see big GDP upside surprises coming through. Unless the government ends up raising import duties on gold substantially, I don't see how the current account can be bridged. With a situation wherein FII flows will definitely be a lot worse than what it has been in the last couple of years, which is the other big problem now. I mean, ETF money chases upside momentum. Right now we have all downward momentum. And remember, this market has fallen to barely $250 million of sales. Right? That's broadly the data, of FII sales. I mean, imagine $1 billion in this market can really wreak havoc, because it's a thin, illiquid market that we have made, quite rightly so, that nobody should be able to exit. They can only enter. So it's almost like the mafia, that you can enter this trade, but you can't exit it.
Okay. That's an interesting thought as well, Shankar. We can probably talk more about that as well. But as you said, it'll probably take till Christmas to discuss these points. Sure. Just one more point, Shankar. And it probably won't happen. But just in case, that I'm giving a hypothesis that the market is lower than where it is right now due to whatever global factors may be. And just in case the elections happen earlier than June 2014, it won't happen. But just in case it does that actually dampen an already gloomy picture?
I think if it is announced, there will be a rally of sorts, because market will say, okay, it has created an uncertainty in its mind that there's going to be early elections. Okay. Although I don't think there should be any cause for uncertainty on that front. But things are volatile in the political space as well. A lot can change overnight. But at least my read as we stand right now is that there's no early elections. But if that were to be announced, I think it may well be that the markets might stage a rally, hoping that now you'll have a stable government, etc., etc., etc. That's pretty possible. So, but we'll see. I mean, I'm not a big believer that you can sit and keep worrying about something that you really have no idea about. So why bother about that today?
Shankar, since you were talking about the point as to how you're monitoring the macros that we're currently working with a hawkeye, when do you see a turnaround, be it on inflation or be it on the, deficit picture that we're currently sitting on?
Aisha, I really think you're going to keep me here till Christmas.
Who better than you, Shankar? Go ahead.
Okay. Look, I think it's again too early to start looking for green shoots. I think, look, it's very simple. The US got a really broken economy. Bernanke got that. And look how he has managed to sort of fly with a single engine for this long, just by keeping a very accommodative monetary policy, despite many opposing that, saying it will lead to inflation, etc., etc., etc. Look how they have managed to keep it afloat. Look at ourselves. We were growing 8.5%, 9% in 2011. That might sound unbelievable, but that was what the data was. And from that point, excessive rate tightening by the central bank here, and then being too reticent to cut rates, that is what has led us here, apart from a lot of global factors, etc., etc., etc. And now you're giving us 25 bips here and 50 bips here, but it's a dehydrated patient. The patient needs to be on saline. Now a mere bottle of chilled mineral water is not going to help. So you have left it too late. You have killed the growth momentum completely because of your completely misplaced rate policy.